Hey there, it's Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything mortgage, interest rate, real estate. So let's jump in. We're going to talk about the different property types and how your rate can differ depending on if you're buying a condo, a townhouse, or a single family home. Before we get into that information, go down there, hit that like button, hit that subscribe. I would be grateful. Make sure and put your questions in the comment area. I will make sure to get back to every single one. So before we actually get into that, let's also talk about where the average 30-year fix. So where are we talking? We're the beginning of June 2021. Our average 30-year fix is at 2.99. Now we are up from 2.95, which is a recent low. We've been hovering around this same level for the last 4 to 5 weeks. We were up for about the previous 7 or 8. We saw our absolute all-time low in January. So now that we've got a basis of where rates are at, let's talk about how we see that. If the average is 2.99, that is the average for condos, single-family homes, townhouses for 3% down, 30% down, right? All across the board. So that means the rates definitely differ to get to our average. So how do they differ based on the property type? That's really what we want to talk about. So if you think about it, a risk from a lender, okay? So I live in a single family home. I'm in Glenview, Illinois. The house across the street is a split level. I am not a split level. They're a little bit smaller, a little bit bigger. If they went into foreclosure, they are not necessarily a comparable sale to me because they could be smaller. They could be on a different lot. They might not even be on an appraisal for my transaction because it's a different property, right? So that's why single families have the least risk possible. There's no HOA, there's no rules. I could rent it, I can do whatever I want. Now, a townhouse is kind of in the middle of those two. Typically, they are alike units, but they're not as far as a condo, where the condo would look at it and you go, hey, the unit next door just sold for $50,000 less. They were in a distressed sale. That is like 99% likely a very, very similar unit to you, right? Because typically, at least on condo floors, maybe you have a different exposure. You get a slightly different view. In Chicagoland, especially in the high-rise market, they will make a view adjustment if you're looking at the big, beautiful city of Chicago skyline versus if you're looking out to the lake or if you're looking out the other direction, right? So that can matter. Condos as a whole, though, they really go up and down based on what's going on in your building and on your floor and above you and below you. There is way more fluctuation with the value and way more risk with a lender, with the end investor, say a Fannie Mae, Freddie Mac, than with a single family home. And that's why they carry more risk and they are equated as such. And what I mean by that is that 25% down on a condo is the same as 20% down on a single family home. You're going to get the same rate in those cases. If you put 20% down on a condo, you're going to have a higher rate because there's an adjustment with literally every lender across the country. If they want to sell that loan off to Fannie Mae, Freddie Mac, get their money back and do it all over again, there is an adjustment. I'm sitting here looking at the Fannie Mae loan level price adjustments, meaning the adjustment to the rate because it's a condo. So at that break of 25% down, it falls off, right? Now you've got so much equity in, you got so much skin in the game, it doesn't matter as much. Before that, it matters. The townhouse does not have that. So it's going to basically correlate directly to the single family home. You're going to have a couple different things like appraisal pieces and whatever when you buy a townhouse versus a single family that you have to go through. Appraisal waivers aren't necessarily as readily available. But with that said, is that they're kind of in the median or really treated more like a single family home. Just because you pay an HOA fee, just because you pay an assessment, does not mean you live in a condo, right? A condo means you own these 4 walls. You insure just these 4 walls. You don't insure your roof. You don't insure the basement or whatever's below you or the neighbor's place below. The townhouse, you own the land that is below you and you own the air above you. And you are insuring the roof most likely, right? Now, maybe there's like a shared unit agreement, some of that stuff, but you own up and you own down and you own all around. You own the concrete in the garage. You own everything else. When you get to a condo, that garage parking space is what they would call a limited common element. So it's a common element to the entire building, but it's limited for just your use. So it's owned by the building, but you get to use it, right? So again, you only own the 4 walls and everything inside. You don't actually own down there in the bottom. You just get to use it. So that's the difference between condo, townhouse, single family home. Hit me up below with your comments. Thank you so much for tuning in. This is Ryan Skaggs for the Mortgage Minute, and we'll see each other again very, very soon.